We believe that bank stocks in India are trading at attractive valuations relative to their ROA, ROE profile, viewed against their own history in most cases, relative to global counterparts, and juxtaposed against other pockets in the market. This is one area which has some margin of safety for investors. In a market where a lot of other pockets are looking increasingly overstretched. Reasons for this are not hard to find. Indian banks, private banks in particular, have high free float comparable to stocks in the developed world, and foreign investors like the two-way liquidity that this provides. Foreign investors have used Indian bank stocks as liquidity taps whenever they needed to exit from India, and this has put pressure on bank valuations. In the previous decades, select private banks created a lot of wealth for foreign portfolio investors, and that too in scale. This resulted in a situation where banks have been viewed in India as proxies for overall economic growth, growth of financialization, growth of digitization in the financial markets, and growth in consumption. This has led to wide ownership in Indian banks from foreigners, and when they have exited India, this has put pressure on bank stocks. The last 2 years, when Indian economy has seen a mid-cycle correction, there have been apprehensions that the asset quality would deteriorate, and this did not happen. First of all, the leverage in the system does not sit on corporate balance sheets these days. Household gearing has been going up, and that's a matter of concern. But banks have been able to manage this through good risk management measures, using technology layers, and given the fact that retail loans are typically shorter tenor in nature. RBI intervened proactively a couple of years back to curb the excess in unsecured lending, and that has helped the cycle to extend as well. A few months back, when the Iran war broke out, there were fears that the credit quality would deteriorate, and this did not happen at all. While profitability of some corporates have been hit and working capital cycles have been extended, repayment ability has not been hit. And as I said, since corporates' leverage is not high, banks are doing just well during the current crisis. Then there is this apprehension that the adoption of GenAI would make Indian banks or banks in general look like public market utilities, and this may be affecting valuations. We believe that the productivity growth and efficiency gains from GenAI will first play out before any other development takes place, and we don't think this is a risk, imminent risk to valuations at all. Finally, compared to global peers, Indian banks are trading attractive, and this will lend a lot of support if there is a market correction. So in summary, we would argue that the credit cycle in India is getting extended. This is very similar to how Golden Quadrilateral project extended the commercial vehicle cycle in the period 2001 to 2008. Low corporate leverage is a tailwind here. The nature of the cycle is such that corporates have given private capex a miss by and large. The buildup of risk is elsewhere. We believe that the buildup of risk in the financial markets is in capital markets, and therefore any crisis in the financial system is likely to where capital markets go. Given this, we believe that the valuations of banks which are looking attractive are just that, they are attractive. So the situation in the Indian market is not at all comparable to that in Korea. Two stocks in Korea, Samsung Electronics and SK Hynix, constituted over 50% of Kospi index at the peak, and the presence of single stock ETFs in both these stocks acted as an accelerant when the market started to unwind. India does not have that kind of concentration risk, and there is no single stock ETF in India that compounds the problem. However, from a risk lens, we need to highlight certain red flags. We have this MTF mechanism in India, which is very similar to a single stock ETF, though the risk is very well distributed against scores of stocks. But in liquid stock with low free float, this can accelerate fall as both products are above leverage, and any fall can be exacerbated by the presence of leverage position through the MTF mechanism. Even in large cap stocks, MTF is a risk as this mechanism doesn't have any short position embedded in it. Presence of short positions would buffer any fall through short covering. This is absent in this mechanism, and this poses a real risk in case there is a fall in the market. While these things are unlikely to result in a contagion in Nifty or in other indices, there could be a sympathetic unwinding in many stocks where these two pan out. Korea also doesn't have a phenomenon like SIPs, which has been driving small and mid-cap valuations higher in India. Now, SIP mechanism has buffered the impact of foreign portfolio outflows, but this poses iatrogenic risks to the market. The mechanism that is meant to act as a shield can turn hostile in certain situations where there is an unwind. The mere presence of a risk factor does not mean that a risk event will play out. In Korea, the risk factor was leverage, but what accelerated the fall was single stock ETFs. For India, the risk factor is overvaluation, particularly in the small and mid-cap space. What can cause a catalyst to emerge could be an unwind in MTF mechanism and the absence of short positions which are there in the FNO mechanism, or risks emanating from exogenous shocks such as crude oil price hike or spike in global bond yields. All these and the confluence of many of these factors is what is causing the worry right now. So the right question to ask is not whether we are in a Korea-like situation, which we are not, but that whether MTF facility poses a risk to the market in the current juncture, and whether the narrative that the market is building up that the overvaluation in small and mid caps can be extended regardless of whatever. These are the questions to ask, and the answer is increasingly becoming more and more uncomfortable. The FCNR deposits have topped US $40 billion as we speak, with nearly 2 months to go before the window closes. This is ahead of most market estimates. This is more a moment of reflection. First of all, this has no doubt bought India time. This does not solve the underlying problem. The number that matter is the cost at which India is being forced to refinance its forex requirements. The 6.25 to 6.5% USD deposit cost that banks pay sits underneath swap cost, which RBI has agreed to substantially bear. Including that swap cost, the borrowing cost could effectively go to about 8.5% to 9%, which is substantially higher than the sovereign bond yield in India, 10-year yield in India, which is 6.8% or so. So the country is forced to fork out a very high cost for enticing the NRI depositors to refinance India's forex requirements. The effective yield which NRIs get from this is as high as 12% when you consider the leverage that the banks are extending to them. Uh, what is also worrying is the use for which one of the uses for which this forex reserve is being currently put to work. Indian banks or the Indian system uh, are lubricating the ease of exit for foreigners by replenishing forex reserves to facilitate the exit of FPI money, which are selling stocks at high valuations, which Indians are buying. So this is a double whammy of sort, and this needs to be kept in mind as well. INR is reflecting this reality to a large extent, and going forward, a lot will depend on how the macro plays out in terms of global developments. Now, the 4.74% 10-year bond yield that we saw towards the end of last week is bad for risk assets around the world. In India, I came across interpretation that this is bad for Indian banks, and we don't agree with that assertion. Banks are not about yields, absolute level of yields, but about spread. Indian banks never benefited from the carry trade from cheap global bond yields. Indian banks did not have access to cheap liquidity that resulted from low bond yields over the last 2 decades. So it's not a bank stock problem, or it's not a banking problem at all. The impact of rising bond yields is mostly felt on equity market valuations. At valuations at which many of the Indian IPOs are listing and trading, the earnings yield hardly works out to 1.5%. This is already very bad or very low as against a 6.8% risk-free Indian bond yield. And as global bond yields spike, equity valuations will come under the scanner around the world, and Indian market cannot be immune at all. This is currently underappreciated in India. The channel through which it could transmit is the currency channel. We've already seen turbulence in this channel previously during this year. And the problem this year or at this juncture is exacerbated by the behavior of Japanese yen and Japanese won. Japanese yen crossed a level of 160 last week against the US dollar, and the US Treasury purportedly intervened to bring it below 160. Now, Japanese central bank is a very large holder of the US debt, and they have been reducing US Treasuries, and which is why the US reportedly intervened. The Japanese bond yield and Japanese yen therefore pose a big risk to India as well. In fact, on another note, Japanese funding, low-cost funding, has benefited India infrastructure over the last 10 to 20 years, and if Japanese yields harden, such financing will also be very difficult to come by. But what makes things worse for India is that the impact of rising global bond yields is very much underappreciated by the equity market in India. Over 95% of the assets under management in India is from an era where we have not witnessed a bond market in turmoil, and we have not witnessed a bond yield scare at the type we are now encountering. This can have a devastating effect on equity market valuations, and if this were to play out, Indian market participants can have a very nasty surprise.